Question 1. A registered representative is explaining the tax treatment of non-qualified variable annuities to a client. If the client makes a lump sum withdrawal from the contract before annuitization, what is the order in which the money is taxed? A. Contributions are taxed first, FIFO, then earnings. B. Earnings are taxed first, LIFO, then contributions. C. Contributions and earnings are taxed proportionally in an exclusion ratio. D. All withdrawals are tax-free up to the amount of the cost basis, regardless of the order. Answer B. Earnings are taxed first, LIFO, then contributions. Explanation. For non-qualified variable annuities, any non-annuitized lump sum withdrawal is subject to the last-in, first-out, LIFO, tax rule, meaning the earnings, which are the last-in from a tax perspective, are considered withdrawn first and are subject to ordinary income tax. Only after all earnings are withdrawn would the client's tax-paid cost basis, contributions, begin to be returned, which is not taxable. This LIFO rule is critical to understand because it means the growth is taxed immediately, and an additional 10% penalty may apply if the client is under age 59 and a half. Remember the LIFO rule. Earnings come out first, which increases the immediate tax liability. Question 2. A mutual fund's expense ratio is calculated by dividing the fund's total expenses by which of the following? A. The fund's total assets under management, AUM. B. The fund's total net investment income. C. The total number of outstanding shares. D. The fund's net asset value, NAV, per share. Answer. A. The fund's total assets under management, AUM. Explanation. The expense ratio is a key measure of the operating cost of a mutual fund, calculated as the fund's total annual operating expenses divided by its average net assets, or total assets under management, AUM. This ratio includes management fees, administrative costs, and 12b-1 fees, but it does not include sales charges or shareholder transaction costs. A lower expense ratio is generally better for investors, as costs directly reduce the fund's overall investment performance. When evaluating a fund, always compare its expense ratio against its peers to ensure the costs are reasonable for the type of investment. Question 3. A representative is conducting an interview to open a new account for a customer and discovers the customer's stated annual income is significantly greater than their stated net worth. Which of the following FINRA rules is most concerned with the representative's responsibility to investigate this potential discrepancy? A. FINRA Rule 2273, Educational Communication. B. FINRA Rule 2341, Investment Company Securities. C. FINRA Rule 3260, Discretionary Accounts. D. FINRA Rule 2090, Know Your Customer. Answer. D. FINRA Rule 2090, Know Your Customer. Explanation. FINRA Rule 2090, the Know Your Customer (KYC) rule, mandates that a representative must diligently attempt to ascertain the essential facts concerning every customer, including their financial status and investment objectives, before making any recommendation. A significant discrepancy between high income and low net worth is an essential fact that may require further inquiry to understand the customer's true financial profile, such as high debt or significant spending, to ensure suitability. Fulfilling the KYC obligation is the first and most fundamental step in protecting both the client and the firm from inappropriate transactions. Question 4. A registered representative sells shares of an open-end investment company, mutual fund, to a client. The sales charge is based on the public offering price, POP. The POP is best defined as the A. Net asset value, NAV, plus the sales charge. B. Bid price plus the redemption fee. C. Current market value plus the custodian fee. D. Net asset value, NAV, less the sales charge. Answer. A. Net asset value, NAV, plus the sales charge. Explanation. For a load mutual fund, the public offering price, POP, is the amount an investor must pay to purchase a share, which is explicitly defined as the net asset value, NAV, per share plus any applicable sales charge. The NAV represents the fund's current value per share, calculated daily, while the sales charge is the commission paid to the representative and broker-dealer. This is the maximum price a buyer will pay, often summarized by the formula NAV plus sales charge equals POP. Question 5. A customer opens a traditional IRA at age 35 and makes contributions for 20 years. At what age can the customer begin taking penalty-free withdrawals without a qualified exception? A. Age 59 and a half. B. Age 65. C. Age 70 and a half. D. Age 73. Answer: A. Age 59 and a half. Explanation: for most qualified retirement plans including traditional and Roth IRAs, the earliest age at which a participant can take withdrawals without incurring the 10% early withdrawal penalty is age 59 and a half. This age marks the point where the IRS considers the account owner to be beginning their retirement phase, even if they are still working. While required minimum distributions, RMDs, start later, age 73 for most today, 59 and a half is the key threshold for avoiding the significant early withdrawal penalty. Question 6. A registered representative would be permitted to sell all of the following securities except: A. Open-end investment company shares, mutual funds. B. Variable annuities and variable life insurance contracts. C. Municipal fund securities such as 529 plans. D. Common stock traded on the New York Stock Exchange, NYSE. Answer: D. Common stock traded on the New York Stock Exchange, NYSE. Explanation: the Series 6 license is a limited representative registration that primarily qualifies an individual to sell packaged products, specifically open-end investment company shares, mutual funds, variable annuities, variable life insurance, unit investment trusts, UITs, and municipal fund securities like 529 plans. A Series 6 representative is expressly not licensed to sell individual corporate securities, such as common stock or corporate bonds, which would require the broader Series 7 license. Always remember the Series 6 is limited to investment company and variable contract products. Question 7. The investment objective of a variable life insurance policy is primarily to provide a death benefit and A. Guaranteed cash value accumulation that bypasses the separate account. B. A variable cash value that depends on the performance of the separate account. C. A fixed premium payment schedule with guaranteed interest returns. D. A tax deduction for premium payments up to a scheduled maximum. Answer: B. A variable cash value that depends on the performance of the separate account. Explanation: variable life insurance is a permanent life insurance product that features a death benefit and a cash value component that is not guaranteed. The policy's cash value fluctuates based on the performance of the investment subaccounts within the separate account, which are managed like mutual funds. This cash value accumulation is a key feature, as it offers the potential for significant growth, but it also carries investment risk for the policy owner. The death benefit and cash value are designed to vary, making them securities requiring a Series 6 license to sell. Question 8. In a corporate bond mutual fund, if interest rates decline, what is the most likely impact on the fund's net asset value, NAV? A. The NAV will decline because existing bonds are less attractive. B. The NAV will increase because the market price of the bonds in the portfolio will rise. C. The NAV will remain unchanged because the coupon rate is fixed. D. The NAV will fluctuate randomly, as there is no correlation between interest rates and bond prices. Answer: B. The NAV will increase because the market price of the bonds in the portfolio will rise. Explanation: the fundamental relationship between interest rates and bond prices is inverse, meaning when prevailing interest rates fall, the market price of existing fixed-rate bonds rises. Since a bond fund's net asset value, NAV, is calculated from the market value of the bonds it holds, a decline in interest rates will cause the bond prices to appreciate, thus increasing the fund's NAV. Conversely, if rates rise, the NAV will fall, illustrating the interest rate risk inherent in all debt security funds. Question 9. An open-end investment company must send out statements to customers detailing all portfolio transactions and holdings at least quarterly. B. Monthly. C. Semi-annually. D. Annually. Answer: C. Semi-annually. Explanation: all registered investment companies, including mutual funds, are required under the Investment Company Act of 1940 to send financial reports to their shareholders at least semi-annually, twice a year. These reports include an income statement, a balance sheet, and a list of the fund's holdings, ensuring shareholders are kept informed about the fund's financial condition and portfolio composition. While many firms provide quarterly statements, the minimum legal requirement for the full financial report is semi-annually. Question 10. Which of the following statements is true regarding a broker-dealer's communications with the public about variable life insurance? A. Illustrations of performance must project only guaranteed minimum rates of return. B. Past performance must be shown as a guarantee of future results. C. Hypothetical illustrations must reflect the deduction of all policy charges and expenses. D. All retail communications must be filed with FINRA at least 10 days prior to first use. Answer: C. Hypothetical illustrations must reflect the deduction of all policy charges and expenses. Explanation: FINRA rules on communications for variable life insurance require that any hypothetical illustrations clearly demonstrate the possible effect of all fees and charges on the investment results. These illustrations cannot guarantee or project investment returns, but they must show both a zero gross rate of return and a reasonable assumed rate of return, e.g., 6% or 12%, after deducting charges. This rule ensures investors understand that performance is not guaranteed and that the fees will impact the actual returns. A key takeaway is that when presenting variable products, all material facts, especially costs and non-guaranteed returns, must be disclosed transparently. Question 11. An investor is subject to the maximum sales charge on a mutual fund purchase, as they are not eligible for any breakpoints. According to FINRA rules, what is the maximum percentage of the public offering price, POP, that a sales charge may represent? 7.5%. B. 8%. C. 8.5%. D. 9%. Answer: C. 8.5%. Explanation: FINRA rules stipulate that the maximum sales charge a member firm may impose on the purchase of open-end investment company shares, mutual funds, is 8.5% of the public offering price, POP. This maximum is only permissible if the fund also offers three specific features: breakpoints, rights of accumulation, and a letter of intent. If a fund does not offer all three, the maximum sales charge must be lower, but 8.5% remains the absolute cap. Question 12. A customer who has signed an IRA rollover agreement with a new firm has how many days to complete the transfer of the funds from the old custodian to avoid the money being considered a taxable withdrawal? 30 days. B. 45 days. C. 60 days. D. 90 days. Answer: C. 60 days. Explanation: a customer who receives a distribution from a retirement plan, such as an IRA, and intends to execute a rollover into another qualified plan has a maximum of 60 calendar days to deposit the funds into the new account. If the rollover is not completed within this 60-day window, the distribution becomes a taxable event and is also subject to the 10% early withdrawal penalty if the account owner is under age 59 and a half. This 60-day rule is a strict deadline for the client to complete the physical transfer of funds. Question 13. Which of the following investment companies issues a single fixed portfolio of unmanaged municipal or corporate bonds and terminates on a specified date? A. Open-end management company. B. Closed-end management company. C. Unit investment trust, UIT. D. Exchange-traded fund, ETF. Answer: C. Unit investment trust, UIT. Explanation: a unit investment trust, UIT, is a distinct type of investment company characterized by a fixed portfolio of securities, meaning the portfolio is supervised but not actively managed. Once the securities are selected, they are held until a specified termination date. UITs issue redeemable shares of beneficial interest, and unlike mutual funds or ETFs, they do not trade in the secondary market and do not have a board of directors or an investment advisor making ongoing trading decisions. The structure of a UIT is designed for a buy-and-hold strategy, offering a predetermined income stream until the trust is dissolved. Question 14. An investment advisor is compensated for a mutual fund portfolio based on a percentage of the fund's average annual net asset value, NAV. This fee structure is best described as a front-end load. B. A contingent deferred sales charge, CDSC. C. A management fee. D. A 12b1 fee. Answer: C. A management fee. Explanation: the management fee is the fee paid to the investment advisor for their professional services of managing the fund's portfolio and making all the necessary investment decisions. This fee is typically the largest component of a mutual fund's expense ratio and is always calculated as a percentage of the fund's average annual net asset value, NAV. It is important to distinguish the management fee from the sales charges, which are paid to the selling broker-dealer and representative. Question 15. A customer wishes to open a new account, but they refuse to provide information about their annual income or net worth. The representative should A. Refuse to open the account, as this information is mandatory for all accounts. B. Open the account but be prohibited from soliciting any transactions for the customer. C. Open the account and use an estimated income and net worth for suitability purposes. D. Obtain a signed waiver from the customer acknowledging the lack of suitability information. Answer: B. Open the account but be prohibited from soliciting any transactions for the customer. Explanation: under FINRA's Know Your Customer (KYC) rule, a firm must attempt to obtain a customer's investment profile information, which includes their financial situation, like income and net worth, and investment objectives, but the refusal to provide this information does not legally prohibit opening the account. However, since the firm cannot perform a proper suitability analysis without it, the representative can only accept unsolicited orders from that customer. This rule ensures the firm's duty to determine suitability is met before any recommendation is made. Question 16. The primary purpose of a letter of intent, LOI, in a mutual fund purchase is to A. Lock in a fixed net asset value, NAV, for all future purchases. B. Qualify the investor for a sales charge reduction, breakpoint, based on a future commitment. C. Guarantee the investor's right to sell shares back to the fund without a redemption fee. D. Exempt the investor from paying any sales charges on the initial investment. Answer: B. Qualify the investor for a sales charge reduction, breakpoint, based on a future commitment. Explanation: a letter of intent, LOI, is a non-binding agreement between an investor and a mutual fund company that allows the investor to qualify for a lower sales charge, known as a breakpoint, by committing to invest a specified sum over a 13-month period. The LOI permits the reduced sales charge to be applied retroactively to the initial purchase, allowing the investor to benefit immediately from a lower sales load before the full amount is invested. For the exam, remember that the LOI is an important mechanism for achieving a sales charge discount. Question 17. The primary difference between a front-end load, Class A, and a back-end load, Class B, mutual fund share is the A. Time when the sales charge is deducted. B. Investment advisor's management fee. C. Fund's portfolio composition. D. Frequency of dividend distributions. Answer: A. Time when the sales charge is deducted. Explanation: the core distinction between Class A and Class B shares lies in the structure of the sales charge. Class A shares charge a front-end load, which is a percentage deducted from the amount invested at the time of purchase. Class B shares charge a back-end load or contingent deferred sales charge, CDSC, which is deducted only if the shares are redeemed before a certain holding period. This difference in timing makes Class A shares more suitable for large, long-term investments seeking breakpoints, while Class B shares are often for smaller investments with a long time horizon to let the CDSC eventually disappear. Question 18. An investment company that has a fixed capital structure, trades on a national exchange or in the over-the-counter market, and often trades at a price different from its net asset value, NAV, is classified as A. Open-end management company. B. Unit investment trust, UIT. C. Closed-end management company. D. Variable annuity separate account. Answer: C. Closed-end management company. Explanation: a closed-end management company issues a fixed number of shares only during its initial public offering, IPO, and after that, the shares trade in the secondary market on an exchange or over the counter. Because their shares are bought and sold based on supply and demand, their market price can trade at a premium above, or a discount below, its net asset value, NAV, per share. This is the key distinguishing factor from an open-end company, mutual fund, which is continuously issuing and redeeming shares at its NAV. Question 19. According to FINRA rules, a registered representative's personal written correspondence with a single client is generally categorized as A. Retail communication. B. Correspondence. C. Institutional communication. D. Public appearance. Answer: B. Correspondence. Explanation: for FINRA communication rules, Correspondence is defined as any written or electronic communication distributed to 25 or fewer retail investors within any 30 calendar day period. This category typically includes one-on-one emails, texts, or letters between a representative and an individual client, which is subject to internal review but generally does not require prior FINRA approval. Retail communication, in contrast, is sent to more than 25 retail investors and requires a higher level of supervision and often principal pre-approval. Question 20. All of the following risks are associated with an investment in a variable annuity except investment risk, B. Mortality risk, C. Inflation risk, D. Guaranteed income risk. Answer: D. Guaranteed income risk. Explanation: a variable annuity does not have a guaranteed income risk, because it is designed to manage the risk of living too long, longevity risk, by offering a stream of income payments that can last for life. The main risks are investment risk, as the cash value and annuity payments fluctuate based on the separate account's performance. Inflation risk, as a fixed annuity payment may lose purchasing power, and mortality risk, which is assumed by the insurance company to ensure lifetime income. The investment risk is the most prominent concern for a new representative to understand, as the separate account's performance is not guaranteed. Question 21. Which of the following retirement plans is generally not covered by the anti-discrimination requirements of the Employee Retirement Income Security Act, ERISA? A. 401k plans. B. Defined benefit pension plans. C. Corporate profit sharing plans. D. Non-qualified deferred compensation plans. Answer: D. Non-qualified deferred compensation plans. Explanation: the Employee Retirement Income Security Act, ERISA, establishes minimum standards for most voluntarily established private sector retirement and health plans to protect plan participants. Non-qualified deferred compensation plans are plans that do not meet the ERISA requirements and, as a result, are exempt from the law's strict anti-discrimination, funding, and vesting rules. These plans are often used to provide benefits exclusively to key executives without extending those benefits to all employees. Question 22. A client has been contributing to a tax-deductible traditional individual retirement account, IRA. When the client begins taking distributions after age 59 and a half, how will the withdrawals be taxed? A. Entirely tax-free. B. Taxed as capital gains. C. Taxed as ordinary income. D. Taxed as a combination of ordinary income and capital gains. Answer: C. Taxed as ordinary income. Explanation: contributions to a tax-deductible traditional IRA are made with pre-tax dollars, and the account grows tax-deferred, meaning neither the contributions nor the earnings have been taxed yet. Consequently, when a client takes qualified distributions after age 59 and a half, the entire withdrawal amount, both contributions and earnings, is subject to taxation as ordinary income. The key takeaway is to remember the tax nature of the contribution. Tax-deductible contributions mean that all future distributions will be taxed upon withdrawal. Question 23. A customer invests a fixed amount of money at regular intervals into a mutual fund, regardless of the share price. This strategy is known as dollar cost averaging. B. Systematic withdrawal plan. C. Reinvestment privilege. D. Constant dollar plan. Answer: A. Dollar cost averaging. Explanation: dollar cost averaging, DCA, is an investment technique where an investor systematically invests a set, fixed dollar amount into a security, such as a mutual fund, at regular time intervals. The benefit of this strategy is that it results in the investor buying more shares when the price is low and fewer shares when the price is high, thus lowering the average cost per share over time. This technique mitigates the risk of making one large investment at an unfavorable high price. Question 24. Which of the following characteristics applies to the separate account of a variable annuity? A. It must be registered as a closed-end investment company. B. Its investment performance is guaranteed by the issuing insurance company's general account. C. It is generally not considered a security and does not require a prospectus. D. It is considered a security and its investment objectives must be stated in the prospectus. Answer: D. It is considered a security and its investment objectives must be stated in the prospectus. Explanation: the separate account of a variable annuity is considered a security because the value of its investment subaccounts, and therefore the cash value of the contract, is not guaranteed and fluctuates based on market performance. As a security, the separate account must be registered under the Securities Act of 1933 and the Investment Company Act of 1940, and its investment objectives, risks, and fees must be fully disclosed to investors in a current prospectus. Remember that variable means it is an investment and therefore a security. Question 25. A registered representative is planning to distribute a research report written by the firm to over 30 retail customers. Before its first use, this communication must be A. Filed with FINRA at least 10 business days prior. B. Filed with the SEC on Form ADV. C. Approved by a registered principal of the firm. D. Reviewed by an independent third-party auditor. Answer: C. Approved by a registered principal of the firm. Explanation: a research report distributed to more than 25 retail customers over a 30-day period is classified as retail communication, which requires prior approval by a properly qualified principal, e.g., Series 24 or 26. While some specific types of communications must be filed with FINRA, the most immediate and universal requirement for all retail communication is the internal pre-approval by a principal. This is a critical supervisory step to ensure the communication is fair, balanced, and not misleading before it reaches the public. Question 26. Which of the following best describes the tax treatment of dividend distributions from a mutual fund composed solely of corporate bonds? A. Qualified dividends taxed at long-term capital gains rates. B. Tax-exempt dividends as corporate bonds are exempt from taxation. C. Non-qualified dividends taxed as ordinary income. D. A return of capital which reduces the investor's cost basis. Answer: C. Non-qualified dividends taxed as ordinary income. Explanation: distributions from a corporate bond fund are considered interest income passed through to the shareholders and are taxed as non-qualified dividends at the investor's ordinary income tax rate. Qualified dividends, which receive a favorable long-term capital gains tax rate, typically come from an investment in common and preferred stock. The type of asset held by the fund, such as corporate bonds, determines the tax treatment for the investor. Question 27. An investor owns mutual fund shares and receives a statement showing a net asset value, NAV, of $14.50 and a public offering price, POP, of $15. This indicates that the investor is purchasing a no-load fund. B. A load fund. C. A fund currently offering a breakpoint discount. D. A closed-end fund. Answer: B. A load fund. Explanation: a fund is classified as a load fund when the public offering price, POP, is higher than the net asset value, NAV, with the difference representing the sales charge or sales load. In this case, the 50 cents difference, $15 to $14.50, confirms the existence of a sales charge, which identifies it as a load fund. Conversely, if the POP and NAV were identical, it would be a no-load fund. Question 28. Which of the following is an unacceptable practice for a registered representative when dealing with customer funds? A. Forwarding all client checks made payable to the broker-dealer to the office within 1 business day. B. Recommending a customer make a check payable to the representative for a mutual fund purchase. C. Accepting a check made payable to the customer and promptly endorsing it over to the firm with the client's permission. D. Receiving a customer check for a mutual fund purchase and holding it for 3 business days before submitting it to the principal for review. Answer: B. Recommending a customer make a check payable to the representative for a mutual fund purchase. Explanation: a registered representative must never, under any circumstances, recommend or allow a customer to make a check payable directly to the representative, as this immediately creates the appearance of improper handling of customer funds and potential conversion. Client funds must always be made payable to the broker-dealer or the mutual fund company directly. This strict rule is a critical regulatory safeguard against theft and commingling of personal and customer funds. Question 29. The payout option for a variable annuity that offers the greatest stability of income stream over time is the one where A. The assumed interest rate, AIR, is consistently exceeded by the separate account's performance. B. The separate account's performance consistently falls below the assumed interest rate, AIR. C. The number of annuity units is adjusted annually to reflect market performance. D. The value of the annuity units is adjusted monthly to reflect market performance. Answer: A. The assumed interest rate, AIR, is consistently exceeded by the separate account's performance. Explanation. In the payout phase of a variable annuity, the stability and growth of the income stream are directly related to the performance of the separate account versus the assumed interest rate, AIR. If the separate account's performance is consistently higher than the AIR, the next annuity payment will be higher than the previous one, which offers a growing and more stable income in real terms. The number of annuity units is fixed at annuitization, but their value fluctuates, meaning performance exceeding the AIR is the goal for income growth. Question 30. A registered representative is completing an application for a variable life insurance policy. When must the customer sign the application? A. After the policy is issued and the customer accepts the initial premium. B. Before the premium is paid but only after the required disclosures are made. C. Only if the customer elects to participate in a specific investment option. D. No signature is required, as the representative can sign on the customer's behalf with a power of attorney. Answer B. Before the premium is paid but only after the required disclosures are made. Explanation. A variable life insurance application must be signed by the customer before the initial premium is paid to acknowledge that the necessary disclosures, including the product's prospectus, have been provided and understood. The representative cannot process the application and collect the premium without the customer's signature. This signature confirms that the customer intends to purchase the product and has been informed of its non-guaranteed features and risks. Question 31. The definition of retail communication under FINRA rules includes all of the following except A. A television commercial viewed by the general public. B. A website accessible to all potential customers. C. A research report distributed to 40 individual clients. D. An internal memorandum distributed only to employees and principals. Answer. D. An internal memorandum distributed only to employees and principals. Explanation. Retail communication is defined as any written or electronic communication distributed or made available to more than 25 retail investors within any 30 calendar day period. An internal memorandum distributed only to employees and principals is specifically categorized as internal communication, which is subject to different review standards and is not considered a communication with the public. Understanding the distinctions between correspondence, retail communication, and institutional communication is crucial for proper supervision and regulatory compliance. Question 32. In a mutual fund, the term breakpoint refers to A. The minimum rate of return at which a fund will stop charging a sales load. B. The level of investment at which an investor qualifies for a reduced sales charge. C. The point at which the fund's capital gains are distributed to shareholders. D. The penalty applied for redeeming shares before the end of the holding period. Answer B. The level of investment at which an investor qualifies for a reduced sales charge. Explanation. A breakpoint is a specific dollar level of investment in a mutual fund at which the investor becomes eligible for a lower sales charge, which is a key benefit offered by many load funds. This sales charge reduction is a feature designed to incentivize larger investments. Crucially, representatives must actively inform clients of available breakpoints to avoid a breakpoint sale, which is a violation where a representative recommends a purchase just below a breakpoint level, causing the client to pay an unnecessarily high commission. Question 33. Which of the following is true regarding the taxation of a Roth IRA? A. Contributions are tax deductible and qualified distributions are taxable. B. Contributions are tax deductible and qualified distributions are tax-free. C. Contributions are made with after-tax dollars and qualified distributions are taxable. D. Contributions are made with after-tax dollars and qualified distributions are tax-free. Answer. D. Contributions are made with after-tax dollars and qualified distributions are tax-free. Explanation. The Roth IRA is fundamentally different from the traditional IRA because contributions are made with after-tax dollars, meaning there is no initial tax deduction for the contribution. The significant benefit, however, is that all qualified distributions of both contributions and earnings are entirely tax-free. To remember this, think of the Roth as tax now, tax-free later, a complete reversal of the traditional IRA's tax break now, tax later structure. Question 34. What is the standard settlement cycle for the purchase of open-end investment company shares, mutual funds? A. T+1, trade date plus 1 business day. B. T+2, trade date plus 2 business days. C. T plus 3, trade date plus 3 business days. D. The same day as the purchase date T. Answer, D. The same day as the purchase date T. Explanation. Unlike corporate stock and bond transactions which generally settle on T plus 2, the purchase or redemption of open-end investment company shares, mutual funds, settles on the trade date T. This is because mutual funds are continuously issuing and redeeming shares, and the transaction is completed directly with the fund company, with the investor receiving the closing NAV on the day the order is received. This difference in settlement dates is an important procedural detail to know for the exam. Question 35. A registered representative is recommending a variable annuity to a retired customer who is 80 years old and looking for a safe place to hold assets for the next 2 to 3 years. The representative should be most concerned about a potential violation of which rule? A. FINRA Rule 2210, Communications with the Public. B. FINRA Rule 2330, Members' Responsibilities Regarding Deferred Variable Annuities. C. FINRA Rule 3110, Supervision. D. FINRA Rule 5130, Restrictions on the Purchase and Sale of Initial Equity Public Offerings. Answer, B. FINRA Rule 2330, Members' Responsibilities Regarding Deferred Variable Annuities. Explanation. FINRA Rule 2330, specifically addressing deferred variable annuities, imposes a heightened suitability obligation on firms and representatives, requiring them to have a reasonable basis to believe the product is suitable for the customer. Recommending a variable annuity which typically has long surrender charge periods, often 7 to 10 years, and high costs, to an 80-year-old client with a short-term, 2 to 3 year, investment horizon is highly unsuitable. For the exam, always connect the long-term high-cost nature of variable annuities with the unsuitability for clients with short time horizons or advanced age.